So we are honored today to have a paragon of the FI community joining us, Karsten Jeske, founder, creator of Early Retirement Now, formerly known as Big Earn. Karsten, on behalf of Jason, myself, and my wife, who wanted me to relay this to you, I just want to start by saying thank you for all the work that you've done on Early Retirement Now. You've given us confidence in our FI calculations, and I'm really excited to speak with you today. So welcome.
Oh, thanks for having me.
Yeah, let me just echo what Eric said. Thank you so much. It's a pleasure to have you here, Karsten.
You know, the FIRE movement likes to paint itself as pretty simple. Like we have the J.L. Collins and the simple path to wealth. We have, the shockingly simple math behind early retirement. We have the 4% rule. But I think one of the things about Early Retirement Now and the work that you're doing is this idea that, especially as you get closer to your FI number and maybe a transition point where you're moving over into early retirement, that you actually have to apply nuance and complexity. And I was personally loath to do that. And especially during this accumulation phase when you are just grinding it out for a long time. When you're looking at things like the 4% rule, C-FIRE SIM, what are the hazards of following something like that, which is very simplified, versus using a tool like your Safe Withdrawal Rate Toolbox, which is a spreadsheet that you have as a resource on your website, which is more complex, it's more nuanced. I'd like to compare and contrast those things and hear you talk about what we're missing.
So again, I'm not saying that other people are wrong. So for example, I think that Mr. Money Mustache should rename this blog post. Right? It's a shockingly simple math to reaching retirement.
Yes.
Right? So that path is indeed simple, right? And it's simple because you're trying to convert cash flows into a big pile of assets, right? And that, at least mathematically, is relatively simple because you contribute to a portfolio, and then returns of these risky assets are also pulling in the same direction. So everything is pulling up, and it's a lot easier to deal with adversity, right? So, for example, if you plan to retire in 10 years, right, and you set a certain asset target, say $2 million, and after 2 years you have $1.8 million, I mean, that's a huge success still, right? And then you can ask yourself, well, could I retire with $1.8 million? Do I just save a little bit longer, right? I mean, whether you retire at age 46 or 44 or 48 or 50, that's all extremely early. It's still a huge financial success. And so the cutoff between failure and success is a lot more mushy and unclear. Whereas, if you run out of money, right, you run out of money, right? I mean, you can't just say that I'm going to die 5 years earlier because I ran out of money at age 80. Something has to give in the end. Whereas it's a lot easier to be flexible on your accumulation path. So, I totally agree that asset accumulation is relatively simple, but then asset decumulation is more complicated. And the amazing thing is, the reason why the decumulation is more complicated is the exact same reason why the accumulation was simpler, right? So, for example, people tell you that, if you're saving for retirement, you shouldn't be too worried about a near-term bear market, right? Because the near-term bear market means that, well, eventually the market will recover again, and then you are buying your new contributions, buy you shares at discounted prices, and then the market will recover again, and you have this dollar cost averaging, which, by the way, is also a form of sequence of return risk. So savers also face sequence of return risk, and they are exactly the flip side of the retiree. And then some of these other anecdotes that people tell in the FIRE community, right? That small changes in your contributions over a long enough time can make huge differences, right? So you just save a little bit extra, and then over 10, 15, 20, 30, 40 years, that amount of money can pile up to some huge amounts. Well, that can also hurt you, right? Because that means if you got your safe withdrawal amount wrong by just there's a relatively tiny amount, right? So there's somebody who retires with a 3.5% safe withdrawal rate, and somebody retires with a 4% safe withdrawal rate. So the simple crowd would say, well, yeah, that's all the same, right? It's just a 0.5% difference, but it's actually not, right?
No,
because
huge,
from $35,000 to $40,000 is more than a 10% difference, right?
That's right.
But again, these $5,000 per year, can you imagine what kind of astronomical amounts they translate into over 30, 40, 50, 60 years of retirement, right? So, and they can make the difference between a happy retirement that where you don't have to worry about running out of money or running out of money in the end. I think the overwhelming majority of people in the FIRE community is still years and years, maybe a decade away from early retirement. And obviously we want to cater to these people and give them the impression that everything is simple. But don't have any illusion. So eventually the math will become a little bit harder.
I mean, and the hazard of following, say, a model like CFIRE Sim and basing your retirement on it is what?
So my main criticism with some of the simpler calculators is that they try to represent something as a probability that is not really a probability. Or if it's a probability, it's not really the probability that I would be after, right? They say that, well, with a 4% safe withdrawal rate, well, you are 98% safe, and there's only a 2% failure rate. And so I would always point out, well, so when you calculate a probability, right, you look at a fraction, right? One is so the number of events that satisfy a certain condition versus all of the universe of events that you would entertain. And so basically what people do is they look at the probability that the 4% rule ran out of money, and you would look at all the different starting cohorts, right? So sometimes starting in 1926, and I forgot what CFIRE Sim does. I think they probably also start in 1871, which is where I start. And so then calculating probabilities out of that seems a little bit nonsensical because you're mixing the denominator has all sorts of cohorts that are not really relevant, right? I mean, I can't put in the denominator people who retire with a 4% withdrawal rate at the bottom of the bear market during the Great Depression or during 1982 or in 2002 or 2003, because we are now we are in a bear market, actually. So we're recording this on June 14th. Mm-hmm. And yesterday we got the confirmation that we're in a bear market. But it's still only, quote unquote, 20% down. Whereas, most people obviously retire at the peak of a bull market, right? Or at what was up to then the peak of the bull market. And then, of course, nobody really knows whether this was actually the overall peak.
Right.
But you're much more likely if you, just like a lot of people in the FI community, we endogenously retire, right? By the time we reach a certain amount of money, then retire. You're much less likely to retire at the bottom of a bear market that way than you are retiring at the peak of the bull market, like in January 2022. So when people talk about probabilities, a lot of these probabilities are probably, pardon the pun, are a little bit useless there, right? So as I always use this analogy, right? I want to find out what's the probability of getting into a traffic jam when I cross the bridge over to Portland. And of course, there's always a traffic jam during rush hour. So if I already know that I go during rush hour, I probably have 100% probability. If I go in the middle of the night, is a 0% probability. So I can't really do this experiment where, I send off 24 people, and each hour of the day at the top of the hour, they go over the bridge. And then I see out of 24 people, hey, only 4 people are in the traffic jam. So 1/6 probability for sure, only 1/6 probability I'll be in a traffic jam. But of course, if I already know that I go during rush hour, the conditional probability is actually a little bit higher. And the same is true with the safe withdrawal strategies, right? So for example, if somebody retires when equity valuations are extremely high, when the market has been in a very long bull market, don't use these kinds of failure versus success probabilities. So
I'm glad that you used that example, and it's nice to hear it contextualized to the current situation.
I agree.
And I kind of want to dig into this toolbox a little bit, if you don't mind, which is your free resource on your website. And we're definitely going to link to it and promote that because my wife and I have been using it. And we actually, Jason and I ran this experiment. We both hired a fee only financial advisor and just kind of put all our financials in front of them. And I basically took a 70-30 stocks to bonds portfolio, and he looked at all the numbers, the same numbers that I inputted into the safe withdrawal rate toolbox, the spreadsheet that you created. And he basically, we were feeling deflated after this meeting because he's like, well, look, there's a high likelihood that based on a 3.3% withdrawal rate and the numbers that you've given me here, that this will not last to your full retirement. I input it into the safe withdrawal rate toolbox, and it actually is suggesting it's using a different methodology, I understand, but it's suggesting an even higher withdrawal rate as the fail-safe withdrawal rate. So,
and Eric, to be clear, you're using very conservative assumptions for growth. You're using actually, I think, the defaults, right, that Karsten has in the tool.
Absolutely. Yeah, no, I'm not pumping the returns in any way because I want this to be a conservative position. And it's just interesting to me to hear you maybe discuss how the tool was developed and kind of walk us through, because there's very few things that me as the end user has to actually input, right? Portfolio
That's
value.
Right.
And you're telling me what the withdrawal rate actually has to be, as opposed to some of these other calculators online, which say enter your withdrawal rate, which I think that's a fundamental difference. Can you talk about that a little bit?
Right. So again, I was personally also impressed with the work from Seafire Sim, but then I kind of outgrew that tool very quickly, and I wanted to do some other things. So the way how I philosophically thought about this was that again, so the big distinction between my tool and a lot of other tools is that my tool works the other way around, right? So my tool says that if this is your retirement start date, this would have been your safe withdrawal rate to exactly reach your final target. Whereas other people say, they kind of throw everything at the wall and then see what sticks and what falls down, and then they determine their safe withdrawal rates. So I find and by the way, the two are the same, right? Because I can still determine the failure rate of the 4% rule, right? I look at, how many of my cohorts had actual safe withdrawal rates higher than 4%, or lower than 4%. And then I can determine what's the failure rate of different percentage calculators. But the nice thing is, I don't have to rerun the whole thing again. Okay, tell me the failure rate of the 4% rule or the 3.5% rule or 3.25% rule. So other people then have to rerun everything again with that different percentage rate. I can just look up everything that's above or everything that's below a certain percentage rate. I don't have to recalculate everything every single time. Obviously, it also takes into account supplemental cash flows, right? So you can model your Social Security payments, future cash flows. Imagine somebody says, in X number of years, I'm going to sell my $400,000 house and I'm going to move into a $200,000 condo. And then these $200,000 is going to be a fresh cash injection into my portfolio. But the nice thing is, it's a relatively trivial formula. So instead of taking one fixed rate and see what fails and what doesn't fail, I'm just going to say, these are the safe withdrawal rates, and they're relatively easy to calculate. It's all just a bunch of matrix algebra and and a few Excel packs.
Yeah. Easy for you.
Easy for you. Yeah. So Karsten, if I can kind of extend Eric's question, why do you think a skilled properly trained financial advisor would balk at the idea of someone 48 who may have 40 to 50 years of runway that this has to last? Why might they balk at the idea of a 3.3 or 3.25% withdrawal rate on a 70-30 portfolio and just say, well, that's just the likelihood of that succeeding, it's not that high. This is way too aggressive. Why do they say that?
I think they might just resort back to heuristics. By the way, I've seen both ways, right? I've seen some people then become so overly conservative that they never recommend anybody retire before age 65, which is kind of insane. I've also seen the other way around, right, where I had some kind of a Twitter battle with somebody who is a member of the FI community and who is a CFP. And basically I try to explain to this person, well, you want to be more cautious with the 4% rule, right? I mean, because sometimes you can be more aggressive than 4%, right? So for example, if you're at the bottom of a bear market, you can be more aggressive. Or say if you retire at age 50 or 55 and you got corporate pensions around the corner, or you could potentially start Social Security, or you delay Social Security, but then 20 years into your retirement, you get this huge cash flow. You might actually, your money might have to last only 20 years, and then you can just completely live off of Social Security alternatively. So I've seen a lot of cases where you should have a higher than 4% safe withdrawal rate, but then also I've seen a lot of cases where you should be lower than 4%. And so basically, I pointed that out to the guy. And so initially, he tried to brush me off. Well, you're trying to market time. And I said, no, it's not really market timing, right? It's just because a lot of the variation in withdrawal rates from person to person comes from just purely idiosyncratic.
Yes.
Characteristics. You can't have the same withdrawal rate for somebody who's 28 versus who's somebody who's 48 or 58.
Yeah.
And so he tried to brush me off like that. So I pointed that out, and then basically he said something along the lines, well, we start with 4%. That's in the books, and if it works, you just increase your withdrawal rate, and if it doesn't work, then you lower it. And I said, wow, I mean that's kind of lazy. So you should think about it more carefully, So I think we're still Twitter friends, but we kind of. I think he muted me and vice versa.
You didn't send him some regression analysis on CAPE ratio or something? Come on, I'm disappointed.
Yeah.
Karsten, let me ask about a different group of people, and I'll put myself out there. And no, I'm not asking for financial advice, but so you're off the hook. But I have talked to a number of people who err on the other direction. And I seem to recall you mentioning, maybe this is very early on in your series, the idea of I'm probably going to target more like 35x savings of my annual spend, and that's what I did. And part of me just keeps saying, like, I'm being too conservative. This has been my reaction to all of this. I could be, I could have more adjustment over time. I could use the concept of valuation and changing with CAPE ratio to change, but in full candor, I'm withdrawing at about 2.7% of my original portfolio starting point 2 years ago for being conservative, and honestly just for ease of spending. Like, my wife and I like the idea of not having to think too hard about what our spend is going to be like, knowing that it is a relatively low withdrawal rate, and if bumps could happen, they're not going to upset us too much. Is that a silly idea? Is it overly conservative? How would you guide somebody who is fixed and on the lower end to consider other options?
I mean, I guess the so there are two ways to answer that. One is, you could say, well, why withdraw more than you need, right? I mean, so you might as well just let the money grow and keep it as a legacy, right? So who knows? Maybe they're going to name a building or football stadium after me or something like that. I mean, maybe a park bench or a building at a university. So I'll see how it works out. So even when you do all this analysis about probabilities of failure versus success, you do all of this completely correct, right? So you take into account asset valuations, and you already chop your sample into, well, I only look at equally overvalued stock market, and I say, well, even with my withdrawal rate, I still don't run out of money. Maybe I want to do an additional safety cushion to that safe withdrawal rate, because, for example, historically there have been cohorts that actually survived a 30-year retirement, but it wouldn't have been a smooth ride. Right. So, and I always use this example, right? So you imagine you fly with an airline that has a failure rate of 2%, right? So it doesn't mean that the other 98% of the flights are good, right? So you might still, especially while you are in the plane over the middle of the Atlantic or Pacific, right? You might have this uneasy feeling, right? So even if I'm not crashing, right? Even the other 98% of the flights are just scary.
Yeah.
And I don't want this. I don't want this in retirement. I want to have this additional safety cushion so that when So you retire at something like with a 3% safe withdrawal rate, and then boom, your portfolio drops. And then even after it dropped by quite a big percentage, you're still only at 4%.
Right.
Then you can say, well, you know what? If I quote unquote re-retired now with the 4% rule, I would probably still make it because the market has already fallen so much. Right? For example, after the market already dropped by 30%, I mean, do you believe that we're going to tag another Great Depression on top of the stock market already dropping 20% as of today, or who knows where it is when this broadcast? Yeah. But I think we've already dropped enough, and who knows if we're going to have. I don't think we're going to have a repeat of the global financial crisis. Right? I mean, it's basically. Right now we are fighting inflation. Usually these inflationary style of recessions, you don't get the kind of drop in the stock market that you had in the global financial crisis or the Great Depression. So I kind of cross my fingers that it doesn't come to that. But I mean, just as you said, right? You want a peaceful and relaxed retirement, and you don't want to have to look at your account statements every day and then wonder, hey, do I have to go back to work, or are we going to make it through? So
if we're returning to the simple rules of the FIRE community, the simple asset allocation in the accumulation phase is 100% stocks, right? All equities. As I'm getting ready to transition, so I'm about 2 years away projected from my FI number, I'm starting to rethink that. And I've just made some, rebalancing. I've changed my asset allocation to say a 70-30. Tell me why that's a bad move or a good move, or, help me kind of come to terms with this, because I'm not totally, I was sort of lamenting the fact that I did that at the end of last year. And now that where we are now, I don't know if it's a good thing or a bad thing. Help me sort of rationalize this. And if I want to walk it back up closer to 100% equities, like I know you did through your whole FI journey, right? The day that you retired, then you reallocated. How would I unwind that and walk it back up?
Right. So this is another friction point with the traditional asset advisors, right? Yes. Asset allocation from financial advisors, right? Because, for example, you go and you look at there's something called the target date fund industry, right? So Fidelity, Vanguard, T. Rowe Price, I think they have the biggest chunk of the target date fund market. You look at what a target date fund does, right? So you keep first of all, you don't even start with 100% equities. You start with 90-10, something like that. And I always say, that 10% bonds for a 25-year-old, that's not really. It's not really based on any kind of scientific evidence. That's more of a CYA thing for both the plan sponsor and the fund company. Whether you have 10% or 0% bonds doesn't really make a huge difference. But then, if somebody complains and sues you, at least you can show that little fig leaf of diversification that you have there. So for all practical purposes, if you're young and you're accumulating and you're using the sequence risk, this is almost in your favor. Right. It's okay to have 100% equities. Now, if you look at these target date funds, usually they start shifting out of 90% equities already something like 20 years before retirement. Yes. Well, what does that mean for people in the FIRE community, right? Lots of people don't even save for 20 years. Right. But even if you say you compress a 45-year glide path and you just squeeze it, so instead of having the transition from 90-10 to 60-40, you do that over 20 years, you do that over 7 years. Well, that's still a lot of, basically opportunity cost, right? Because you are shifting out of the highest returning assets and shift into the diversifying asset. So I always look at, how were these glide paths constructed, right? And they're usually constructed by using two assumptions. Right? So the first assumption is that you have a very rigid retirement date. So it's which could be a good model for some people, right? So some people have a retirement date that is kind of there's not really much wiggle room, right? There's some people. So I think commercial airline pilots. They have some kind of a mandatory retirement date. There's some people who work for the government and they wait for their 20-year vesting period, and they say, I'm not going to work 1 day longer, and so I've got to work exactly 20 years, and then I retire. So there is that aspect. So if you have a very inflexible retirement time, then you could say, well, I mean, look, I don't want to retire at the bottom of the bear market, right? And even though you could say, again, if you retire at the bottom of the bear market, right, you don't apply the 4% safe withdrawal rate. I mean, you might apply a 6% withdrawal rate because, well, equities are so cheap, and you might be just starting another bull market. But yeah, I could see that if you have a very rigid retirement timing, then maybe you want to take a little bit of risk off. And I have a little bit of trouble justifying this glide path into that safer asset allocation over a very long horizon. So I think if you do this kind of a stepwise sliding path down over the last 2 or 3 years of your working career, and you do this gradually, because you will always create this regret factor, right? If you do this as a one-time shift, I mean, you would have looked probably okay if you had done this when stocks were really high. Yeah. But then again, don't forget bonds got hammered too, right? So interest rates are going up, and you're losing in your bond portfolio, and the inflation is high, and nominal bonds suddenly don't look so good. So keep that in mind. But I mean, you will always create this regret factor when you do this as a one-time shift, and so keep that in mind. So this is why I probably say, and you also want to probably take the emotions out, right? So imagine you shift, and then you realize, it was kind of a bad timing, and then you shift back, and then you get whipsawed, and so take the emotions out. So you do what you do in every other aspect of the FI journey. Right, you automate stuff, right? So you take the emotion out, you take the market timing aspect out of it, so I've actually written a blog post. I think it's part 43 of my series, where I looked at, well, what's the asset allocation for the last few years of your accumulation, right? So just to maximize my quote unquote my utility at my retirement date. And I mean, there were some people who say that they are not too risk averse. They have a high risk tolerance. I mean, they can even stay at 100% until retirement. Or you take somebody who has some flexibility in the retirement month, and if right at that final point, and you still have 100% equities, and you find yourself in a bear market, well, maybe work a little bit longer. And then also factor in that you obviously have a little bit of more wiggle room. If you retire in the middle of a bear market, you also have a higher a withdrawal rate just because of asset valuations. And then the other thing I wanted to mention is that I think that some of these target date funds, they're actually calibrated incorrectly because they rely on just pure Monte Carlo simulations. Mm-hmm. So the problem with the pure Monte Carlo simulation is that you have trouble mimicking what's often happening in the real stock market, right? Because you have this momentum, big draft down during the global financial crisis, but then you also had, so for example, if you go from March 9th or whenever was the low point, March 9th, 2009, exactly 365 days forward, I think you had something like a 70% return in the S&P 500. And you can generate that with just a pure Monte Carlo simulation. So what that means is that potentially anything that is calibrated with the Monte Carlo simulation in terms of the glide path is probably a little bit too cautious, because it means that obviously with Monte Carlo you can generate a 50% drop in the stock market, but after a 50% drop in the stock market, well, what is the expected return in the stock market from then going forward? Well, it's just, again, your 7% or whatever you calibrate. Right. You can't really replicate very easily these sharp reversals. And so what I found in that blog post where I looked at the different glide paths is that if it's easier to justify high equity shares when you use historical data instead of Monte Carlo. So again, I mean, if you have a high enough risk appetite, you can stay at 100% equities. If you have some flexibility in the planning and timing, you can probably still at 100. You can be at 100%. But yeah, probably everybody else wants to shift down a little bit.
So if I said I rebalanced end of last year, so things were up, looking pretty good. Not a bad time to do it probably, but now things are getting hammered, and I'm looking at the stock market and I'm like, ooh, maybe I feel like being all stocks now. How would I unwind that position, that 70-30 position, if I wanted to? Just do it all at once? Is that what you're saying? Is that a bad thing?
So I used to work in asset allocation. So we of all things, I mean, when I worked for BNY Mellon, we were not stock pickers. So we did the global asset allocation. So I mean, sometimes just 3 asset classes, right? Is a short term. So something like 3 months T-bills, intermediate bonds, so something like a 10-year treasury, and then equities, S&P 500 index futures. And how do you allocate between these 3 asset classes? I mean, you normally wouldn't do an all-in thing, right? I mean, this is usually you shift your weights, but you don't do it all at once, right? And again, there's going to be some regret factor going on, and nobody really knows what's going to happen. I mean, I know what happens tomorrow, right? Tomorrow is the FOMC. The FOMC meeting is already going on today, and it will be announced tomorrow. So there's relatively little uncertainty about what they will announce as the interest rate move tomorrow. It is a 50 basis point increase. I can already go on the record, and when this broadcast, people will probably agree with it. But there's some uncertainty about what is the outlook, right? Yeah. Are they going to just yank up the interest rates up to 4, 5, 6, 7, 8% in the future? Even if they're thinking about that, they're probably not going to say that out loud. But so anybody tries to find these signals and reading between the lines. So I think both for the equity and the stock market is kind of all everything is on the table. So I would probably, if you do any kind of move, I would probably do it gradually over time. So, and then if it works in your favor, then you can say, okay, now at least I have a little bit of a cushion. So if I keep going, even if the subsequent moves don't go my way, I mean, at least I had a little bit of a cushion, and I'm not too regretful. Sure. And even if it goes against you, then you can say, well, I'm so glad I didn't do the entire bond portfolio shift over to the equity. So now let me do a little bit more because, well, it's gone against me, but it's not going to be every single day and a single month it will go against me. So this is why I actually think I would do this a little bit more gradually. Sure. But I mean, I can't tell you either way which way it will go. Yeah. Do I find bonds better or stocks better? Everything looks a little bit shaken up right now. Yeah. And
there's more bad and less bad. You know, we've talked about the bucket strategy on this show. It's fairly common. I've read a lot of different takes on it, you know, whether it's window dressing for really just asset allocation and rebalancing. Kitsis has written about that. You've written about it. I mean, at the concept level, it makes good sense, right? You want to have a certain amount of cash to meet your obligations with, irrespective of what the market's doing. It's nice to have something to sell even when equities are way down. So having X number of years, which varies a lot, of fixed income makes sense. How would you distill your feelings about that, the bucket strategy, and it as a potential tool in retirement once you're drawing down?
Right. So I think we can all agree that we don't want to be 100% equities in retirement, right? So we need some risky assets and we need some diversifying assets. And how do I decide what is the percentage? So, I mean, I looked at my simulations and I said, well, probably you want to have your risky asset equity somewhere between 60 to 80%, and the rest should be some diversifying asset. And then you really have to decide, well, what should that diversifying asset be? Oftentimes, bonds work really well, right? Because you had this negative stock-bond correlation over the longest stretch of time. Now it's breaking down a little bit, by the way. So maybe you don't want to have everything in bonds. You have to have a little bit in cash as well. And So basically what seemed to have worked in history is something like 70% equities, maybe 20 to 25% bonds, and 5 to 10% cash, as in, say, money market account or T-bills. And if somebody uses a bucket strategy and they arrive independently at a similar allocation, I mean, I'm happy, right? So we agree, and we have kind of a robust asset allocation concept, and some people arrive at it from some kind of maybe a efficient frontier analysis. Some people do some historical simulations for retirees, and some people have this bucket idea. I think I can totally live with that.
Okay.
Now the problem, of course, is that how do you change the bucket weights over time?
Yes, right.
So, and of course, if you don't change the bucket weights over time, then you're back to my simulation spreadsheet, right? So it's basically you rebalance every month, which in the extreme you could rebalance every month. Maybe it's too much effort. Maybe you rebalance only every 3 months or 6 months or 1 year. I wrote a blog post. It doesn't really matter the rebalancing frequency. It could be a hit or miss. Sometimes it's better. I can show you some examples where it just turned out worse because you just had the worst time where you rebalanced. You just rebalanced at the bottom of the stock market. Or you were lucky that you grabbed the bottom of the stock market. So it could go either way. Again, so if you rebalance your weights, you're back to essentially a static asset allocation. And then really the buckets are window dressing, right? Because you think you take money out of your cash bucket, but of course the bond bucket feeds the cash bucket and the stock bucket feeds the bond bucket. And if that's some sort of a psychological aid for you because you don't want to, in fact, this is why financial advisors like it so much, right? Because the clients don't want to take money out of stocks and they're afraid of touching the principal. And then the advisor can tell them, oh, but I'm taking money only out of the cash bucket. And then they just do the rest as kind of an automatic rebalance. So the client doesn't even understand that, even though, I would actually prefer, instead of kind of deceiving the client, educate the client, and maybe that's better. The other idea is that the other thing that works, because we talked about glide paths, right? So there's a glide path into retirement, right? So while you're still working, you're doing a glide path towards your retirement date. Then once you're in retirement, there is actually some research out there that says that you should now have a relatively low-risk portfolio, but you can, over time, again, shift into the higher-risk bucket. And the reason for that is again, the sequence of return risk, because so much depends on, say, the first 5 to 10 years of your returns. Yes. And maybe during that time, you take a little bit less risk. And then later on, you take more risk. And the idea with this glide path is, and both Kitzes and Wade Pfau have written about that. I've written on my blog about, I think it's parts 19 and 20. The nice thing about this glide path is it's a little bit like an insurance policy, right? So, for example, if the stock market totally rallies and kills it, then you leave a little bit of money on the table, right? Because then, you should have been at a higher equity portion, but that's okay, because if the equity market rallies during the first 10 years of your retirement, you don't have to worry about anything anyways. But then if it's the other way around and you have a really poor market, then you stay a little bit out of the mess, and then later on, when the market recovers again, then you're back at a higher equity portion. So it works in that sense. And what I like about that policy is that it's something that you can automate, right? So you take the emotions out. You have almost a table, and you say, I start at 60-40, and then over time I slowly shift into an 80-20 or 90-10 or even 100-0. There's actually not market timing, right? This is more of a timing of your life cycle, right? So it's independent of market conditions. You don't shift. And then part of the shifting is already generating exactly what people desire, right? So for example, if the stock market is down, so that means relative to the targets is some of the other buckets are up, and you take money out of those buckets. So almost automatically it looks like a bucket strategy. So you're only consuming out of the safe assets. So I would agree with that. So that's actually one of the methods that is not going to solve sequence risk, but it can take the edge off a little bit. So let me get one last thought in. So the one thought that I'm a little bit troubled about that kind of bucket strategy is when people start talking about, okay, I use this as a market timing method where I'm actually smarter than everybody else, because remember, if you're trying to time, is the equity market more attractive, or is a cash balance, say in a money market account or 3-month T-bill, is that more attractive? So you are now getting into the business of timing the equity risk premium, right? And of course, so equities on average, they should pay more than a risk-free asset. But obviously there's a huge dispersion of equity returns. And if you could adequately time the equity premium, you could do much better. But guess what? I mean, that is what everybody else is trying to do. And what is particularly worrisome is, and you can talk to anybody who has worked in this space, so including myself, any kind of valuation scheme is not going to be very useful in short-term timing of the equity premium. So, yes. I mean, people will tell you ideally what you do is you sell equities when they're expensive, and you sell your cash buffer if equities are cheap. And of course, in a perfect world, I mean, this is just going to work really nicely. And but it's not going to work that nicely, right? Because, I mean, in the end, say, imagine you're starting with something like a 2-year worth of expenses cash buffer, right? And then you start drawing down your cash buffer so you don't have to touch your equity. So what happens if after 2 years equities are still down? In fact, they keep going down. Right. What do you do now? Do you replenish the entire 2 years with just one big chunk, right? Which could be tens of thousands, actually over $100,000 all at once. Or do you do this stepwise? Do you already replenish slowly over time? Again, so because we're talking about relatively small amounts, so it's not like you have some sort of a timing scheme where you take your entire multi-million-dollar portfolio and shift it back and let it slosh between stocks and cash. So we're talking about some relatively small amounts of the portfolio. And so first of all, you have to come up with some sort of a timing scheme, right? Yeah. And even if you find a timing scheme where, say, I can squeeze out an extra 1 percentage point of return out of my cash versus stock market timing scheme, which, by the way, you can't. It's not if you're using any kind of valuation scheme. It's momentum as a kind of a trend following scheme that might also be hard. So, but imagine you can add an alpha, right? We call this alpha. So alpha is this excess return that somebody can generate if you follow some sort of a timing strategy, either stock picking or market timing, and you generate this 1% extra return. But we're talking about, say, a few months worth of expenses, right? There's a tiny fraction of your portfolio. So even if you have something like, on average, you start with this 2-year worth of expenses, you draw it down to 0, then you replenish it, then you draw it down. So on average, you have 1 year worth of expenses in your cash bucket, which is an average of, that would be an average of 4%. So it jumps back and forth between 8% and 0%. So you have 4% of your portfolio, and you can get a 1% extra return on 4% of your portfolio. So we're talking about a 4 basis point extra return. So if somebody has, say, a safe withdrawal rate of 3.5%, and somebody says, well, I can squeeze out an additional 0.04% of extra return, you can't just increase your safe withdrawal rate from 3.5 to 4.5%, right? Because the extra 1% return is only on that small portion of your portfolio. So you increase your withdrawal rate by 0.04 basis points. It's not that much. So this is why I'm a little bit cautious about the people who want to say, well, I can market time myself through a bear market. It's going to be harder than you thought. And if it is a very strict and rigid rules-based program, I mean, show it to me how it worked in simulations. It's probably harder than you think, because equity valuations are okay for forecasting something like 10 or 15 years. It's very hard to forecast equity premium, any kind of a timing scheme with valuation. So it's and if it is something completely discretionary and emotional, then I'm kind of doubtful too, because then that's hard to verify, and it's hard to get this consistent.
So you would apply just a rule set that says this is what I do.
Yeah, it could be a rule, and then again, the rule has to be based on some kind of principles, right? So, and again, if you read some of the posts from Kitces or from me, I mean, this is not some random finding, right? There's some mathematics behind the fact that over your life cycle you should have different risk targets, right? Yeah. So you can have more risk when you're really young, then you draw it down to your retirement date, and then you can take more risk again as you age in retirement. So there's some math behind it. So that's not market timing. That is the timing of your personal life cycle.
Makes sense.
So I can hear the comments coming in, and we get comments like this all the time. I'm sure you get them on your blog too, like dividend paying stocks.
Oh yeah.
Right? That's the solution to this, right? Because they just throw off cash. They perpetually, yeah. So let's put this to bed, because I'm honestly so tired of hearing about it.
Yeah, you know, the funny thing is, I mean, there are two things again that I think the FIRE community gets right? And then so keep things simple, right? And stock picking doesn't work, and market timing doesn't work, and the funny thing is, I write this whole 53-part series, and then people just leave a comment. Oh, you don't have to write your series. I mean, it's very easy. Just do stock picking or market time.
Right. Bingo.
It's done. It's almost like you're in a comedy show or something. Right? So it's almost is there a laugh track coming in the background? Yeah. So, but I mean, I think. If we agree that stock picking is something also quite difficult, so we are now saying that all of these stock pickers, they just overlook the one really obvious thing, right? So they should just go all into dividend stocks, and then you can beat the market. And of course, it's not true, right? So, then the people try to tweak this a little bit, right? They say, well, we don't just look at high dividend payers, because you could be in this value trap, right? So this is this trap where the stock got completely clobbered, right? So the price went down, the dividend is still relatively high, and the dividend yield looks really high, but well, it's just a question of time until dividend gets cut. Okay. So then people come up with these additional screens, right? So the screen would be, well, you have to be not just a dividend payer, it has to be a dividend payer that has been consistently paying dividends, right? Yes. So it turns out, right, until 2008, what were some of the most consistent dividend payers? Right, it's financial institutions. Right? The Bank of America, Citibank, they were all. I think Bank of America for sure was one of the companies that made it into this dividend aristocrat screen, right? So because they had been paying consistent dividends, they're always raising the dividends, well, until they stopped paying dividends or they cut their dividends drastically. So, and then on top of that, right, so not only is your dividend cut, right, so but now you can say, well, now I sell. Well, do you sell the stock now after they cut the dividend, right? So it's kind of too late now because the price got clobbered. Do you sit it out? So my general theory is that I don't think that this dividend strategy and dividend pumping really works. Now, I have to be also careful, right? Because I don't want to say that dividend stocks are consistently underperforming, right? So I'm just saying that it's a kind of a hit or miss, right? So there have been recessions and bear markets where dividend stocks performed a little bit better. It turns out that in 2008, it was actually roughly a wash, right? So some of the financial stocks performed really poorly, but some of the more brick and mortar stocks, they performed a little bit better during the 2008 recession. So if you look at the returns of something like a U.S. dividend stocks versus U.S. just the broad market S&P 500, they weren't so different. And I found that some of the dividend payers, they were a little bit underperforming the S&P 500, but I wouldn't really rub that in too badly. And then on top of that, the fact that that dividend payers in some recessions, they underperform. I'm not saying that they underperformed because they paid dividends.
Sure. Yeah.
I'm saying that there were some other factors. There were some industries that are traditionally more likely or less likely to pay dividends. So, for example, during the pandemic bear market, it was mostly growth stocks that did relatively well. So the non-dividend payers, the IT stocks that did relatively well, and dividend payers got hammered. Turns out that in the current bear market, it's actually the other way around. So now it's more of the high-flying IT stocks that got hammered, and then some of the old brick and mortar stocks are now catching up again. So again, I'm not saying that underperformance or outperformance is because of dividends. It's because of other factors, and then they're just sometimes dividend stocks are doing well, and sometimes they don't do well. It's a hit or miss. So yeah, I mean there's some additional risk from doing that dividend route, and I'm very skeptical. And I've written, I think it's parts 29, 30, and 31 on my blog. So I wrote this blog post. I thought I could kind of dispel this dividend myth in one blog post, but I mean, these dividend people, they are persistent.
Relentless.
They're very zealous, I would say. They're true believers.
Awesome. You know, we've been talking about simplicity with the FIRE movement here. The investing strategy, you know, there's a time where you're just grinding it out. The transition point into early retirement, once you hit your FI number, and then those first couple of years in early retirement. Since you've navigated both sides of FI here, what would you be doing in those couple of years before and the couple of years after, leading up to and through that transition? How do you capture both sides of that? What would you be doing now? And especially given the current market conditions, inflation. I know you're not that worried about inflation, but speak to this kind of current transition zone, because we have a lot of viewers who are kind of in this space right now.
Actually, I got a little bit more worried about inflation. So I'm writing a blog post on that. So that's coming up. But no, I mean, so imagine if I had just shifted my time by 4, 5, 6 years, and I would now be 2 years before retirement, right? And I mean, the funny thing is, I did have a little bit of this moment in 2018, right? So in 2018, we had this very long lull period and very low volatility, and then suddenly in February 2018, right around the time when I was supposed to announce my retirement, the equity market volatility started again. And then 2018, for example, was one of the not so good years in the stock market, right? There was the last time we had the calendar year negative return in the S&P 500, I believe. So so if I were 2 years before retirement, I would probably just operate just as before, work hard, put as much as you can in your nest egg, and kind of grind it out, as you said. And I mean, in some way, not thinking too much about it is probably better, right? So because if you just scrutinize it and you worry about it too much, it's not very helpful. And
but I have to remain flexible, right? I mean, that to me seems like a big, I can't put a 2024 date on it, even though I want to.
I think you're probably still okay for the 2024 date, right? Because again, it depends on how the next 2 years work out, right? But if we have a relatively average and benign bear market, and by that time, probably the Federal Reserve will start lowering rates again already, and not quite sure if the S&P is going to be back at 4,800 points, but even if it is a little bit below that, right? I mean, the good thing is that valuations look a lot better now. So, and I recently looked at what would be your safe withdrawal rate conditional on the S&P 500 already being 20% below the peak, right? And that's really the kind of exercise we should look at, right? I mean, we don't have to compare today anymore to, say, September 1929 or December 1972 or something like that, or what was it, as August 2000 with the CAPE ratio of about 40. So we are already a lot better positioned, and if the wheels don't completely come off over the next few years, I think you'll still be fine. I'm a little bit worried, and this is a little bit my concern, right? So we have 8% inflation, and the Federal Reserve is basically meddling with some rate hikes, going from basically 0% to a little bit over 1% so far, and then I think 1.38% tomorrow, right? So it's a 1.25 to 1.5% range. So take the midpoint as 1.38%. Strictly speaking, the Fed should already be at something like 7, 8, 9% Fed funds rate, right? If they were actually serious about fighting inflation, right, we would have, because right now we have a negative Fed funds rate if you inflation adjust it, right? And so that's a little bit a worry that I have right now, that people don't actually realize how worse things could become, in the sense that if the Fed has to basically do a repeat of, say, 1982 and get inflation out of the system, they're going to break the cycle, engineer a recession, and then get this inflation spiral out through a big recession and rate hikes. I still cross my fingers that there's just going to be a slowdown a little bit, right? There might be a little bit of hangover anyways from the pandemic. People will probably stop consuming as much as they have been. That will take some pricing pressures off. And that would obviously be the ideal scenario. And then by the time next year, the Fed is probably going to be at something like 3.5%. And then they start lowering rates already. And we have inflation rates that are coming down. That's normally pretty good for investors. So I always caution people that even if you know the inflation rate over your entire next 30 years of retirement, it doesn't really have any kind of informative power on what the safe withdrawal rate would have been over that 30 years. Equity valuations help you a little bit, but not so much the inflation rate. And it's normally it's not so much the inflation rate itself, it's more of the direction of the inflation rate that could be good or not so good for asset returns. So I kind of cross my fingers that in 2 years when you retire, we might not be completely back to normal, but just being on the path back to normal, you will probably be in a good shape, and hopefully you just worry about nothing right now. So
thanks, God. Thank God you said that, Karsten.
Can't you feel better? I mean, you're still contributing at very high rates. That's how I feel. You are buying the bottom, or you're buying low, right?
I appreciate that, and I'm just going to put that on loop in my earpiece.
Yes. You should
dial the anxiety back.
So it's a lullaby.
So the person who just entered retirement now, transitioning there, Karsten, is, I mean, they're on the opposite side of this, right?
Right.
Yeah.
Right. And so I mean, if you just retired today, I mean, you're probably in a pretty good shape, right? Because equities are already better valued. Equities are already 20% down from the peak. And so I'm a little bit more worried about the people that retired in January, right? And the people that retired in January, and they pushed it a little bit on their safe withdrawal rate. So instead of 4%, they went to 5%, and basically now have a much higher effective a much higher effective withdrawal rate. Right. So they would probably be a lot more worried. They might have to cut their expenses and maybe pick up a job here and there. But yeah, I mean, for most people in the FIRE community, I think we should be fine.
It would be nice to hear the kind of FIRE life that you have for yourself now, Karsten. Right. If you don't mind sharing, like, kind of what's going on, what does summer travel look like? Are you doing some revenge spending? Yeah. Like, I want to hear the fun stuff.
Yeah. So, I mean, it doesn't really feel like retirement. In fact, right now you can probably hear my daughter. She has a piano lesson in the background.
That's great. I love it.
So life is just pretty normal here. So we live in the suburbs. After that long and aggressive travel schedule in 2018 and 2019, so we took it a little bit easy in 2020. Last year, I think we traveled for a month, but only domestically. So went to Colorado and South Dakota and Wyoming, visited family in Georgia. This year, we're going to do 2 trips. So we'll be in Europe for a month, fly to Netherlands, Germany, Belgium, Luxembourg, and then take a cruise to Norway out of Amsterdam. So nice. That's always a lot of fun. We already did a cruise in May to Alaska. And so, I mean, obviously right now, the travel schedule is a lot more limited because our daughter goes to school. But yeah, so I think the 2 months of travel time that we can have and probably will have this year, that's kind of enough. And I can tell you after the 2 months, I'll probably be happy to be home again.
Yes.
So because after we come back from Europe, I think we have 3 days here at home, and then we fly to Alaska again and do a road trip there. So Anchorage and Fairbanks and Denali, and then take the cruise ship back to Vancouver, BC. So yeah, so we stay busy, right? We have a daughter, so we get up every morning at 6:30 and get our daughter ready. I take my daughter to the school bus, and it's not your typical retirement because of that. But yeah, so we stay busy. I'm blogging. I'm going to pick up a new teaching gig for next year at UC Berkeley Extension, and
they hired you back.
trying to stay busy, and so it's. But then again, I mean, I don't have a stressful job. I don't have to go to the office every day. I don't have to do performance reports anymore. And I always say, you know, it's stressful to be in retirement and basically, okay, I mean, this nest egg, that's all we ever have, right? So we might do a little bit extra here or extra there. But it's nothing is as stressful as taking care of other people's money. So so I had a stressful job, and I'm happy I don't have to do that anymore. And we so have a pretty sweet life here in Washington State.
That's amazing. Well, I appreciate you sharing all that and all of your time with us and information and critiques of our plans. And yeah, I'm so thankful for you. So thank you, Karsten.
You bet.
Yeah, thanks a lot. Just echo Eric's thanks. Really appreciate it. I think there's just tremendous value here that we're looking forward to sharing with the community, and certainly we'll link to all the relevant pieces of your extensive series, not just the in safe withdrawal rate, but anything else that makes sense. And certainly I would highly recommend people check out the toolkit. It's as you've heard, it's very informative.